I'm Leia Halapan.
I am Marcel Lusak.
And I am Lady Queen Litohon. And our topic to be discussed is all about interest rate and their role in finance.
So for today, my topic is about concept of interest rates and the demand for velocity and the money. So interest rate is the amount that is charged for a loan or purchase made on credit, typically expressed as an annual percentage of the loan or credit balance. The interest rate represent the cost to the borrower for taking out the loan or making a purchase on credit, and is the rate of return for the lender or the creditor. For just an example, a bank charges interest on amounts loan or on the balance on overdraft. A bank also pay interest to the owner of an account with a positive balance, and interest rates vary depending on the type of provider of borrowing. So the types of interest rates. The prime rate is the best known for the various interest rates that are utilized. This non-fluctuating rate is the one usually employed by banks when it makes short-term loans to large borrowers such as corporations. Other important interest rates that are used in making capital investment decisions include discount rate, treasury bill rate, treasury bond rate, corporate bond rate. Factors affecting market interest rates. There are other factors can be important are saving by individuals, international capital flows, and amount of a premium required by investor to compensate for the interest rate risk. So there are five most factors interest rate in economy. The first is the strength of the economy of the willingness to save. So interest rates are to determine in a free market where supply and demand interact. The supply of funds is influenced by willingness of consumers, business, and governments to save. Second is the rate of inflation. People's willingness to lend money depends partly on the inflation rate. If prices are expected to be stable, we may be happy to lend money for a year at 4% because we expect the percent more purchase. At the end of the year, the inflation rate is 10%. Third is the riskiness of the borrower. Medium of exchange money is an instrument that facilitates ease to transfer of goods or services. By acting as a medium of exchange, it commands purchasing power, and possession enables us to purchase and goods and services to satisfy our wants. To it overcome drawbacks of barter exchange of goods and services for other goods and services. So a common measure of value money is the measuring root for everything. It acts as a common denominator by permitting everything to be priced in terms of money only. Therefore, people are enabled to compare different prices, thus the relative values of the different goods and services. Standard deferred of payments. In general, payments are spread over the period of time. For example, when goods are bought under hire purchase, they are given to the buyer upon the payment of deposit, and he pays it by number of installments. Hence, the use of money permits postponement of spending from the present to some future occasion. So the store value of money permits people store their income. Thus, it is used as a store of purchasing power. It can be held over the period of time and used to finance future payments provided value is stable. The demand for money and velocity of money are inversely related. Over the long term, the link between money and growth and inflation is strong, but money velocity is not constant over the short term. So some short-term inflation may be caused by an increase in money velocity. Although the velocity of money cannot be measured directly, nor it is not predictable over the short term, it is determined by the both of demand for money and the supply quantity of money. An increase of money supply will lower money velocity, while a decreased money supply will increase money velocity. All else being equal. But in the short term, the money supply is considered constant. The velocity of money is the frequency that one of the unit currencies is used to purchase domestically purchased goods and services within a given duration. The number of times of dollar bills spent to buy final goods services per unit of time. Demand for money depends on quantity of nominal money people like to hold in liquid form. Income levels. Pricing levels, higher the prices, higher will be demand, higher the interest rates of return on assets, to lower would be demand liquid money. Innovations like ATM lowers the demand for liquid money. Theories of demand for money. Quantity theory of money. Classical approach, one of the oldest theory propounded by Irving Fisher. There is a strong relationship between money and price level. Hence, the quantity of the money is the main determinant of the price level or the value of money. Higher the number of transactions people want, higher will be the demand for money. First version also as the equation of exchange or the transaction approach. It as MV equals PT, means with actual money. MV plus MV equals PT. And credit money among the M means credit money of circulation. The transaction of velocity of circulation of a times money is spent. B equals circulation of money. It's average or price level of transaction. The Cambridge in neoclassical approach, since sales and purchases do not occur simultaneously, people need temporary abode or purchasing power as the hedge of against of uncertainty. Hence, demand for the money also involves precautionary motive. Demand for money depends partly in the income and partly on the other factors. Higher the income, greater the quantity of the purchase, and hence greater will be need to money for uncertainties. Demand for money under the Cambridge approach is stated as MD equals KPY, means demand for money. Y equals real national income, and P equals the average price level of currently produced goods and services. PY equals nominal income, and K is a proportional of nominal income that people want to hold as cash balance. In Cambridge theory is chiefly concerned as a means of transaction stating transaction demand.
Interest rate, it happens between the lenders and the borrower. Borrowers is the debtor who has an obligation to pay the money he borrowed with an interest and additional amount, while the lenders is the creditor who lends his money with an interest when borrowers repay or pay back him in a later time. It is an additional payment to the borrowed money. In interest rate, there are two types of formulas, such as simple interest formula and compound interest formula. Simple interest formula is calculated as simple interest is equal to P times R times T. P represents as principal amount. It is initially borrowed from investment. R represents rate of interest or rate of return. T represents as time. It is the overall number of months or years where investment is done. Example, what is the interest rate with the principal amount of $10,000 in 5 years if the interest rate per annum is 15%? P is equal to $10,000, R is equal to 15% or 0.15, T is equal to 5 years. Using the formula of simple interest, which simple interest is equal to P times R times T. Simple interest is equal to $10,000 times 0.15 times 5 years is equal to $7,500. Therefore, our simple interest in this problem is $7,500. And now let's talk about the second interest formula, compound interest formula. It is calculated as A is equal to P times 1 plus R over M times MT. P represents as principal amount. It is initially borrowed from investment. R represents rate of interest or rate of return. M represents as number of times compounded annually. And T represents time. It is overall number of years which investment is done. Example, Mr. Z makes an initial investment of $5,000 for a period of 3 years. Find the value of investment after 3 years if the investment earns the return of 10% compounded monthly. In this case, our P is equal to $5,000, R is equal to 10% or 0.10, M is equal to 1, and T is equal to 3 years. Using the formula of compound interest, which is A is equal to P times 1 plus R over M times MT. A is equal to $5,000 times 1 plus 0.10 over 1 times 1 times 3. A is equal to $5,000 times 1 plus 0.10 times 3. A is equal to $5,000 times 1.10 times 3. A is equal to $5,000 times 1.331. A is equal to $6,655. Therefore, our compound interest in this case is $6,655,000. Prices is what product or services cost. It is the money exchange of product or services that people take. There are three major and common pricing strategies. First is cost-based pricing. It is the product price that based on production cost. Second is value-based pricing, also known customer-based pricing. It is finding the price that suits to customers' budget and they are willing to pay. The third one is competitive-based pricing, also known competitive pricing. It is a pricing method after observing competitors' selling price on the same or similar product. In this part, there are several major product pricing methods. So first is competitive pricing. It is a pricing method observing competitors selling price on similar product. Cost plus pricing. It is a price adding to the cost of product in selling price. Markup pricing is a price charged for the item in product retailing. It expressed through percentage and the percentage applied to the cost of actual item. Demand pricing. It is a customers-oriented form of pricing. Demand for money. It is a total amount of money that individual wish to hold. It is related to the income, interest rate, and whether people prefer to hold cash or illiquid assets like money. There are several types of demand for money. Transaction. It is a money we need in our day-to-day life to purchase goods and services to our daily needs. Second is precautionary demand for the money. It is the money we need to purchase in unexpected way or emergencies. The last one is asset motive or speculative demand. It is people demand to hold the money rather than buying bonds.
What is velocity? Velocity of money is the rate of circulation of the money in an economy. It is the fraction of money that is used in a year. It is also defined as the speed of which money flows in an economy. In simple terms, we can describe the velocity of money as the speed at which money is being spent in an economy to buy goods and services. It can either be a dollar, a euro, or any other currency spent to purchase these goods and services. Income earned by an individual enables them to purchase more freely, which tends to increase the money velocity. So, how can we calculate velocity of money? Formula. The velocity of money equals to PY or GDP, gross domestic product, divided by M or the quantity of money in the economy. For example, $8 million divided by $2 million is equal to $4 million. Then, the velocity of money is 4, meaning the average dollar is used in 4 transactions per year. Why is the velocity of money so low? Velocity of money becomes low when there are less exchanges for goods and services. This can be due to reduction in GDP or an increase in the money supply in a state of low inflation. What happens if it's become increased? If the velocity of money increases and there is no exchange in the money supply, the increases in money demand will drive price higher. This inflation increases the nominal's GDP. Why is velocity of money is important? The velocity of money is important for measuring the rate of which money in circulation is being used for purchasing goods and services. It is used to help economists and investors gauge the health and vitality of an economy. High money velocity is usually associated with a healthy expanding money. Velocity money because whatever the aggregate use, the velocity of money can strengthen or weaken the effects of a change of the amount of money. There are 3 types of interest. First is the nominal interest rate. Nominal interest of an investment or loan is simply the stated rate on which interest payments are calculated. Essentially, This is the rate on which savings accrue interest over a period of time. Example, here's the formula. Nominal interest equals real interest rate plus inflation rate. If the nominal rate on a loan is 5% and you can expect to pay $50 of interest for $1,000 borrowed. At the year's end, you'll pay $1,050. Just add 50 plus 1,000 is equal to $1,050. Second is the effective rate. The effective rate, interest rate, takes into account compounding over the full term of the investment. It is often used to compare the annual interest rates with different compounding terms, daily or monthly, annual, or etc. Formula: effective in interest rate equals 1 plus I or interest rate divided by n or number of compounding period n to the power of n minus 1. Example, monthly is 5%. 5% divided by 12 is equal to 0.05, which is I. Then n, which is 1 year or 12 months. Just follow the formula. R equals 1 plus 0.05 divided by 12 times to the power of 12 minus 1. So R 0.0512 divided by equals 5.12%. Just convert into percent. Last is the real interest rate. The real interest rate is useful when considering the impact of inflation on nominal interest rate. In essence, the real interest rate deducts the rate of inflation from the nominal interest rate. This means that if the nominal interest is 5% and the inflation rate is also 5%, the real rate is effectively. Formula: real interest equals nominal interest rate minus rate inflation. To find the real interest rate, we take the nominal interest rate and subtract the inflation rate. For example, 12% interest rate and the inflation rate is 8%, then the real return on the loan is 4%. What factors determine interest rate? There are a number of factors that determine the interest rate offered by banks in return for your investment. These include the chance of default by the borrower, the residual term, the payback currency, the respective country credit rating, the number of commercial banks in the country, and the national projection of savings versus credit. The type of savings account chosen is also a determining factor.